right, round 3, Steve. See if this sucker can work. All right. Is the real estate market going to crash? Sorry for the false alarms. I've got my good friend Steve Ploetz joining us via the phone today. What's up, Steve?
Woo! How are you?
You should see the super snazzy picture we have of you up on the screen right now.
Pull it up right now. Oh, look at that.
Yeah. Wow. Model material.
That guy looks sharp.
Model material. So this is kind of Steve, this is the big thing I want to talk to you about today because, I was bearish on the real estate market and got it wrong a couple times. And what I've kind of failed to see in the midst of that was how much the government is behind real estate. And this is the reason, beyond all the financial schematics and all those different things, the government is behind real estate in a bunch of different ways. And I will, be going into some of this stuff, including the Fed and the amount of support that they're providing. And it doesn't appear, a lot of people think that the Fed support of the mortgage market is based on interest rates, by them cutting the federal funds rate, but it's not. It's more about the bond market, which is the real market. A lot of people think the stock market is the real market to watch, but it's not. It's the bond market is where the big boys play. So what we're going to look at here first, Steve, so Goldman Sachs is considered to be one of the most reliable sources for predicting the market. A lot of extremely wealthy people give their money to Goldman Sachs so that they can use it to invest it in different methods and so forth. And they have a bunch of different ways that they invest money. Now, Goldman has come out and says that this downturn, the one that we're in right now, is going to be, quote, 4 times worse than the housing crisis. Now, that right there is a pretty big statement, okay? But what they also say, and I think this is the thing that's important not to miss here, they also say that then an unprecedented recovery, okay? Why is this all important? Okay, well, here's the deal. When you look at what's taking place right now in the real estate space, in any and all financial markets, what we have is a completely and totally unprecedented situation. We've never seen anything like this before. We really, don't know how to approach anything like this. No one knows what's going to happen next. But here are the things that we do know. We do know that, first of all, we've seen some steady growth. Yeah, actually, you know what? Steve, let me do this first. What are your thoughts on that? Give me your perspective on this, because I am personally seeing a huge bull market. I mean, every buyer that I'm talking to, everyone we're in a battle to get people's offers accepted. It's multiple offers. It's highly competitive. This has not changed through the entire thing. Am I living in a bubble, Steve?
Well, Derrick, I am a simple man. I've been searching for some chords underneath these hands. You talk about all of these the different graphs, we've talked before about what's happening with crime and all these different giant macroeconomic factors. I always try to feel like what I'm most interested in is dumbing it down so that someone that is a real estate agent like myself, that is not tremendously educated, can figure it out so that I can advise people on what's happening, where this is going. Here's the market. The market, as of everybody knows, as of like a month ago, in March 14th, was super low supply, low interest rates, high demand. And so the question that I've received a lot is about is this a bubble? Are we going to experience what we experienced in 2009? So again, looking purely at supply and demand, the demand has changed. The buyers that are jumping in there is a group of them, and I would say some demographics like amateur investors that at the beginning of the year said, you know what, my New Year's resolution is I want to buy an investment property. I've heard these guys say that the way I can really build wealth is through real estate. So I'm gonna jump into real estate. Those guys have gone away, in my opinion. But there are still buyers buying all the times. If you and I have one that opens today.
Yep.
He wrote 2 offers. One of the properties has multiple offers. I've got a couple of listings right now that had multiple offers going well over asking price. So just looking basic supply and demand, the demand is shrinking, but is still greater than the amount of supply. What's the difference now, in my opinion, and the data shows, versus like 2009 when things were going really sour, is at those times there was supply hitting the market. Foreclosures, short sales, that sellers that were just throwing inventory on the market, and we had shrinking demand and tremendously increasing supply. Right now, actually, what in my opinion we are in, and what economists, like there's a guy, Stephen Thomas, that I really, really like, what the data is showing is we're actually in a balanced market right now. This market
Really?
that we are experiencing is the market that is like after Christmas, like for those 2 weeks there. And here's what that means. Number one is, in a balanced market, there is great opportunity for both buyer and seller, because these transactions are getting a lot more fair, in my opinion.
Okay.
What we're getting is, in the past, 2 months ago, a buyer had to give up their firstborn child, their virginity, their liver, in order to get their offer accepted. Now, you're getting situations where both buyer and seller are reasonable. And they're saying, good, let's work together. You want to buy it? I want to sell it. Let's make a deal happen. My last thought, and then the difference between doing a call this way is I can't see the visual cues when I can tell that you're about ready to interrupt me. I have to get to the point quick.
Don't worry, I'll let you know when I'm ready to interrupt you.
Well, my feeling is that in this kind of market, there is, if a buyer is out looking at property or writing offers, that's a real buyer. If a seller is on the market, they are a real seller, because all of the wishy-washy, I know I've been told I need to jump into real estate, so I guess we should look, and all of those buyers and all of the sellers that are saying, if we can get what our neighbor got, then okay, I would be willing to sell. One benefit, in my opinion, of COVID-19 is it's very obvious to now see people's motivation. Either they are serious or they are waiting. That's it. There's no middle ground. And so the listings that you see on the market as a buyer, those are sellers that want to sell.
Yep.
I mean, obviously every seller wants to sell, but those sellers, that motivation is changing. They are understanding, because none of us know what this looks like, and everybody is, my opinion, should be most concerned about what June and July looks like. I have a partner. We talked about what we really need to do. We have many escrows going now, and they will close, or they will get sorted out. The listings that are on the market, we will figure it out. We will be able to close those. The hard part is finding the buyer or seller that shows up May 1st, that's ready to buy June 1st or July 1st. I think COVID has made it very crystal clear to see buyer and seller motivation, and at least my experience, once you get into escrow, everybody wants to close the deal. And we can talk, certainly from the lending side, about figuring out, can you fund loans? As Comstock says, are loans funding? I mean, those are real questions, and there's real challenges when you get outside of conforming loans and jumbo products and non-QM and all the different jargon. But in its most simplest form, inventory remains low. Interest rates continue to be low. Demand is shrinking, but we're in a balanced situation, and suddenly everybody's getting really reasonable and like, okay, let's do a deal. Let's facilitate this.
Yeah.
Let's work together.
I'll tell you, I was cross-qualled once yesterday and cross-qualled once today, and in both cases, even the cross-qual lenders were like, okay, tell me about it. Credit score good? Got DO? Okay, all right, sounds good. It was not the normal cross-qual, situation where it's like, yeah, hey, you have to give me your client if you want them to get this house. So, I think that you're right about, you see demand shrink a little bit because of the fear factor is really what we're dealing with. There are some lending, changes that have made things a little bit more difficult too. The additional VOEs and things like that. There are some people in escrow who fell out because of the fact that, well, let's be honest. If someone has a job and they get, they tried to kill one of my deals as I'm putting my NMLS information on the screen. I do obviously loans. And so what happened was this individual works in an industry that is not working right now. The place is just shut down. Works for a hotel shut down. So, she wasn't let go officially in the beginning and then was officially let go. And once you're officially not employed there anymore, you can't use your income. So we had to restructure the deal. We actually saved the deal. We saved the deal. It'll close, 4 or 5 days late, but we were able to save the deal, restructure it completely, and make it work. But a lot of those deals aren't getting restructured, aren't being saved, and they are falling out. And that was the big question, was how much fallout would there be? How many people who were looking to buy, and I've got several of these people, I wonder if you do too, Steve, who are sitting there going, you know what, I'm not working right now, but I want to go ahead and do my pre-approval because as soon as we go back to work, I want to start looking. And I've got a bunch of people like that too. So I think that, there's definitely still a lot of things going on. What I wanted to point out, though, was what was said in this article, because you see, the way that the news constructs these things, and you can see, and this is a really important thing. So I went to journalism school, University of Missouri, did a lot of writing intensive classes. I took the classes I wanted to take, but the ones that were structured around journalism were really interesting because a lot of people don't realize this, but when it comes to the news, and remember, this is late 90s, so they were teaching us how to write for the newspaper and or do television. That was it. There's really not much of an internet at that point. And the headline writers and the article writers are not only two different people, but they have they're like two different departments. And they're two different bosses. And they're two different things completely. So when you see this headline, the first part of it is the fear-based part. Goldman says downturn will be 4 times worse than housing crisis, comma, then an, quote, unprecedented recovery. Then you look at the key points. The global economic hit from the coronavirus crisis will be far worse in the near term than the financial crisis. This is according to Goldman Sachs. In the United States, second quarter activity likely dropped 35%. And unemployment, they say, could hit 15% just in the second quarter. Those are things that they're predicting, and they're probably right. However, the recovery in the second half of the year could be stronger than anything the U.S. has ever seen. So let me give you a few tips here. Well, actually, let's look at this too. So, you know what? Let's start here. I'll go back to myself. So, a couple things. Let me give you a couple things here, Steve. Right? Can I tell you how things work, Steve? Are you ready to listen? Huh? So here's the first and most important point. But I'm going to go through each one of these points are crucial. And I was unable to find a sufficient rent graph, so you have to bear with me on some of these things. But the first thing, and this is a really, really big one because we did not have this last time. So we're going to draw some different things here between the crash that we experienced last time and what's happening right now, which is a balancing of the market. And they're two very different things. You can see here, prior to the crash, and these are real estate prices, the S&P Case-Shiller National Home Price Index. So home prices kind of went up here just unabated before the downturn. And look how much time we had prior to the recession. So there was tons of time between the peak of the market and the time the recession took place. This is like 1.5 years, this distance here. Now, during this recession, obviously, home values went down. And they kind of trickled down until we found a bottom down here in 2011, 2012. But what you'll notice about the growth is that as they increase, they level off, increase, level off. These level offs are the market saying, okay, we accept this as the new normal. So we see a small rise and then leveling off. Rise, level off. Rise, level off. Rise, level off. Rise, level off. That's where we're at. So the first thing is we have a steady growth scenario. A steady growth is super, super important. When you look at real estate in general, what you don't want to see is exactly what happened right before the crash last time, which is just unparalleled, straight up type movements. Those are not good. Those are not healthy. Those are the definition of a bubble. When you go through the stairs that we've been through recently, that puts you on some solid ground. That is a lot less looking like a bubble. So that's number one. Steve, you got your notepad out? Because I got more.
I'm using the chalkboard here. That's so you can't see it.
All right. The other thing is, last time, the government was very slow to get involved. The government was sort of blindsided the last time this happened. They really didn't know what was going on. We had the transition from Bush to Obama. Bush didn't know what was going on. Obama had no idea what was going on. He'd only been in politics for a couple of years. All of a sudden, he's the president of the United States. He doesn't know anything about finances. And here he is, the president, in the midst of a global economic crash, a depression, basically, throughout the entire globe. So he didn't know what to do. It took him a while to figure things out. This time, we're way, way, way ahead of what's going on, okay? We had the government taking measures almost immediately. I mean, we had a multi-trillion dollar package, stimulus package, that was approved and passed within 30 days. I mean, it took a year and a half. It took almost 2 years for the government to actually do anything. And a lot of the stimulus and the things that happened from the government, from the crash, all happened afterwards. It was all reactionary stimulus. It was, oh, we've got to do HARP to protect people who are already hurt. Oh, we've got to do this. We've got to create bills around this. We've got to do the 1099 thing. We've got to create Debt Forgiveness Act. They did all that stuff as reactionary things. So we were spending all of our resources trying to catch up with all the mistakes and all the bad things that had already happened. This time, way, way, way ahead. Multi-trillion-dollar stimulus, and this sort of happened under the cover of night. I mean, we had a $2.6 trillion stimulus that was approved by Congress, and then the guys who do stuff without congressional approval, the Federal Reserve, they went out and put $2.3 trillion in to support the economy as well. And by the way, they're constantly pumping tens of billions of dollars into the economy. I hope that all the bow tie guys who believe in inflation, which I understand, it says it in all the economics books, but it hasn't played out. Okay, it hasn't played out anywhere in the world that I've seen, and I don't see it playing out here either. And that's the reason why I believe the Fed is saying, hey, listen, we're just going to keep pumping money into this. And if you look at the things that they're saying, they are saying we will do whatever it takes. Guess what? That's a guy with a blank check telling you which side of the transaction he's going to be on. So if you have any sense at all,
when we receive that money, I mean, I agree with you that politically they've tried to get in front of this as quick as they can in order to pump money in. And I know that it's now been weeks, and many clients, many landlords, many realtors. There's the California Association of Realtors, the National Association of Realtors that are providing PPE stimulus loans. I know a few people that have been approved. I know nobody that has received money yet. And to that point, and to your point, I still believe that money is what is needed, is to create the security, is to have the safety net for all these people. And it's going to be interesting to see when that money starts coming in, because I know that those departments have just been overloaded.
I can tell you that a lot of it's already coming in because of what the Fed's doing. And that's part of the reason why the Fed took action. I'll just go ahead and show you right here on my handy-dandy mortgage chart. So this is mortgage bonds. Now, what here? All this action right here, this is normal market action prior to COVID-19. We get up to this point right here, and there starts to become some scares, right? This starts to be in March. We're talking about, this is like when the lockdown happened right here. Okay, so all this was the confusion in the marketplace, not knowing what the heck was going on. All of this right here is the Fed not knowing quite what they were doing yet. Okay, so this whole action right here was the Fed kind of going, okay, just dump money onto it. And it sounds like a good idea, but it's like taking a fire hose to a thirsty man. It's like, oh, you need water? Well, here's a 30,000 gallons a second, and they screwed a lot of stuff up by doing that. Now, since then, they've gotten their act together. They know what they're doing. You're seeing these smaller bars. You're seeing that, mortgage bonds are still being purchased, but they're setting a stage. And you could see based on what happened yesterday, where we lost a lot of ground in mortgage bonds, but look at the range they've decided to keep this in. They've said, you know what, let's keep this here. Now, mind you, this is a graph of the 2.5% bond, okay? So 2.5%, and it's trading in the 104 plus range. Actually, we're just under that right now, like 103.8 or something. So what that means for people who don't invest in bonds is 100 is the basis. So if you bought it at 100, you're making 2.5% on your money. If you buy it up here, you're making less than that. So the higher it goes, the bond price goes, the lower the yield goes. So yield's dropping a lot, and this has a lot to do with the fact that the 10-year has dropped so much. I mean, you have to go out, as far as T-bills are concerned, Steve, you have to go out to the 20-year to get 1%. And if you go to the 30-year, you don't get much more than that. So what we're being told and what we're being shown here is that, number one, the government, particularly the Federal Reserve, Congress may or may not get things done. There's going to be pork in there. 80% of probably the stimulus is crap. But they're doing things, but the Federal Reserve has the green light, has the full support of the administration, has the full support of the populace. There's no one to stop them. Only a few bow tie guys who say inflation will kill us all one day, but we've never seen any of it. Those are the only guys who are upset about this. So essentially what that means is that the Fed is going to get to run rampant. They're going to get to do whatever they want, unhindered. And if they are pro-real estate, if they are pro-mortgage bonds, then you better get your ass on the same side of the equation that they're on, because they will smoke you. They can drop tens of billions of dollars into a market, which is exactly what they did in mortgage bonds. And as a result of that, they can change the market like that. So we have a serious big brother who's protecting us here. We can feel free to walk into the lunchroom very confidently, okay? Now, another thing, and this is a very, very important one, Steve, and I know that you've experienced this and you understand this because you own properties as well. Rents are much higher now than they were during the housing crisis. During the housing crisis, we actually had so many homeowners, so many people were able to buy homes that it was more difficult to find renters, and therefore rents were much, much lower. Now we have a situation where rents are much higher, which means that pencils more often for people to buy homes. And here's the thing about rents. Rents don't fluctuate as quickly as home values can. So, I mean, when you get sign up to rent a place, you're signing for at least a year or a year and a half or 2 years. So even though the market may shift during those times, unless the market has shifted from the time you sign until the time your lease is up, you're stuck in that rental agreement. Now, the concern has been that people will be defaulting on their rent and that will cause ripple effect problems. But where are you going to go? That's the question. Where are you going to go? Because if there aren't new places being built, or if there isn't inventory opening up somewhere where the deal is cheaper, then your better option is to try to stay where you're at, especially in this situation, Steve, because what we have now is we have a situation where it's more difficult for people to have open houses. It's more difficult for people to own rental properties or Airbnbs or things like that to do things along those lines because everyone's afraid of moving or going anywhere or being around people. So that means more likely people will want to stay put, which means they're more likely to try to pay their rent or to try to work it out with their landlord if they do intercept a big hardship. And if you are a landlord, I would suggest that you stay in touch with your tenants and ask them how they're doing and know what's going on in their world, because the last thing you want is for rent to just stop showing up and they've already made plans to have a bad exit when you could have gotten in front of something like that. So I haven't heard about that happening a whole lot. Have you heard about anything like that happening, Steve, with renters?
Well, so I mean, about 2 weeks ago when we got to the first, that was the conversation that I was in every day with 20 people leading up to the first was, what does this look like as a landlord? What are my rights? Am I going to collect rent? If not, how does it look for eviction, et cetera, et cetera? As you know, California drastically protects the tenant. But also, I mean, they've put a lot of things in place in terms of there's a moratorium on eviction, meaning that if the tenant is able to prove that the reason that they cannot pay full rent is because of COVID-19, then as a landlord, you are unable to evict them. And what they say is if it's not related to COVID-19, so if they're doing things that are unsafe, et cetera, you could still evict them, but the courts are closed. And it's going to be I think that's what's going to impact the market the most, is figuring out how does this all play out truly when we get to May 1st, for a variety of reasons, in my opinion. Number one, that's another 2 weeks down the road. We'll have an idea of, there's so much conflicting information that's out there, which is California going to try to reopen? There's some saying, hey, I need these 6 things hit in order to get things back on track. I know Trump is eager to get people back to work and open up the economy. And, of course, then you've got the balance of the science, which says, hey, is this real? Is this safe? Is this really what we want to do? But my expectation, and just so you know what I was telling all my landlords when they said to me come March 25th, hey, we're 6 days away here from the first of the month, what should I do? My recommendation to them was punt. Try to get April rent and then figure out what it looks like in May. So that then say, hey, because it basically happened 2 weeks before that, the first of the month, they probably have that rent. And if they don't, you'll need to get some documentation. But likely, we're going to be fine for April. The big discussion, Mr. and Miss Landlord, is going to be, what does it look like May 1st? And then, how do you work through it? If we see a situation where a bunch of landlords all of a sudden say, I can't make this payment, I don't have any income coming in. Okay, Steve, list the property, and we see a significant amount of inventory, then we may see that shift where demand continues to shrink and supply continues to increase, and it does turn into more of a buyer's market kind of situation. But I don't foresee that. I really don't. I don't foresee situations where selling tenant-occupied property right now is incredibly difficult. Recommendations that I'm making to several sellers is, and of the listings that we have, 1, 2, that are in escrow, all but 1. 4 are vacant. 1 is occupied. And it's so much easier these days in order to sell vacant property. And on top of that, you try to show a tenant-occupied property where a tenant feels like, hey, coronavirus, I don't want a bunch of people tromping through my space. And they have the right in order to say, I'm not going to allow these showings, or, hey, we need to work through this in a way that makes sense. Right now, basically what the state of California has said is, we're behind you, tenants. We got your back. We'll make sure that if anything's COVID-related, we're going to protect you. So I don't see that inventory coming on the market, and I don't foresee, in my opinion, at least in the short term, that there's going to be a bunch of panic sellers, that there's going to be a bunch of people that say, throw it on the market, let's see what we can do. We may see vacant properties of amateur investors or normal investors, or just people that have decided, in this market, I don't want to mess around and be a landlord anymore. Okay, we'll list it come middle of May. But until then, there continue to be buyers that are looking out there. Owner-occupied buyers, I think there's some great opportunities, because if you find a good place, those sellers tend to be pretty reasonable right now. I think it's a balanced market right now. It's a great opportunity right now, and it's also, there is a little bit of like wait and see come May 1st, because I think that's going to be the next big change that we'll see either way a couple weeks away.
You think it's the next big test is in May? Yeah, I could see that. That makes sense. But I'll tell you, Steve, I'm not done with my list. So here's an important one. And this one, and we'll show on the graphs here. So real estate and mortgage was not the cause of this. So when we look at the last crash, particularly, that began right here. Okay, let's call this 2006, 2007, early 2007. And when this began, it was caused by essentially Wall Street. But Wall Street took over the mortgage market. What Wall Street did, for people who don't understand what happened in the last crash, is Wall Street was able to buy off the bond rating agencies. So, and they only had to buy off a few people in order to get them to stamp AAA on their shitty bonds that they were selling. So that's the reason why you saw all these crazy programs, because Wall Street said, just go get the paper. Just go get the paper. Go get the paper. Get it to me. I can get it stamped AAA and we'll sell it to Iceland. And that's what they were doing. So they packaged up all these mortgages. They sold them. It was all BS. They bought off the ratings agencies. And so it was caused by the mortgage industry. So not only did we have this unsustainable growth formation, but we also had a situation where the entire economic problem itself was being caused by essentially fraud inside at the deepest depths of the real estate and mortgage industry. In the real estate industry, the deepest depth of it is in the mortgage space. But this time, it's not caused by that. So that is an important thing to understand, because there is no stigma around real estate or mortgage during this particular economic situation. There's no stigma. Back then, if you recall, there was a tremendous amount of stigma with the real estate and mortgage market, to the point where people, thought we were responsible for this, and that, it was our fault, and this whole thing has happened because of you guys. That is not going on. So sentiment toward real estate is not damaged by this. That is huge. That is huge. And the hard asset classes that exist, I think people are actually going to be gravitating towards real estate when you look at how you can't get any money on your paper. The stock market is a super risky place to be right now, even though it keeps going up. We are about to see some of the worst quarterly reports we've ever seen. The stock market's going higher. I've never seen a setup so obvious as this one. But they're trying to pull suckers in because they realize that people aren't sure what to do with their money, and they want to draw as many people in the stock market as possible right now. That's what's going on. So, if there is no safe place for your money that you know of that's paper, where are you going to go? You're going to go gold, silver, titanium, Palladium. I mean, what are you going to buy? Real estate. That's what you should be buying. That's the thing that makes sense. That's the thing that works, And so when we look at that, real estate and mortgage not being the cause, that's huge. Also, the economy, Steve, was in fundamentally an incredible place prior to this. There was no cracks in the economy, though people will say, well, we had the inversion, we had the crossover with the bond yields. Yes, we did have a formation that signals a potential recession coming forward, and that has to do with interest rates being too low for too long, essentially. But aside from that, fundamentally, we were continuing to see jobs being created. We were continuing to see the stock market go higher. We were continuing to see companies do really well. The biggest issue that we have economically right now is that a bunch of the really big companies that are household names, Uber, Lyft, Redfin, all the different DoorDash and apps, all the apps that we use on it, all those companies, for the most part, have not made, in fact, all the ones I just listed, have never made a profit. And yet they are, the market cap for those companies are tens of billions of dollars. So you tell me how my son, who has $5 to his name, has more money than these big companies, and yet they're valued at tens of billions of dollars. Why? Well, because it's information, because infrastructure, because all these different things. But that just shows you how far we've gotten from a fundamental analysis of the value of a company. That in itself is a little bit dangerous. Outside of that, fundamentally, the economy was in really, really good shape. And even if we look at what Goldman said, and Goldman is being, I think, very, I would say, out front about this, because they have to be, in saying that, hey, this downturn is going to be really bad, but the recovery on the other end of it is going to be equally amazing, or inversely amazing. And so the reason why they might believe that is because, listen, fundamentally, we were chugging along. Perhaps what this is a shakeout. Perhaps what this particular pause in the economy is going to do is it's going to shake out the companies that were fragile, the businesses that weren't doing that well, that were probably on their way to the toilet anyway, anyone who was unable to adapt quickly. I mean, it's essentially like the theory of evolution, but in business is what's taking place. And people are having to adapt.
Derrick, I'm going to interrupt you with two questions.
Please.
I got two questions just because I'm simple-minded here. So number one, I want to know, let's say you have $100,000 right now. Mm-hmm. You just got beat up. Your 401k just got beat up in the stock market. You and I are talking about the levels of uncertainty. Goldman Sachs is saying, hey, this bounce is going to be unprecedented, but wait, because it's going to get ugly. What are you recommending? What are you, as Joe the electrician, doing? Do you hang on to that money right now and put it in a checking account? It sounds like what you're saying is you don't trust it in the stock market. Would you jump into this market right now, the real estate market, or would you wait?
Yeah, I mean, here's the thing. The best thing you can do, if you're Joe the electrician, is to be smart about making a long-term plan. I mean, if you have it in your head that you're going to make $100,000 the next 90 days in real estate or stocks, you're just thinking wrong. The great thing about real estate is that you don't have to be savvy. You don't have to be a genius. All you have to do is have a decent plan and have time on your side. I mean, look, I'll pull up the graph. Look at this. So it doesn't matter who you are or what you did. If you bought real estate anywhere on this graph, and this goes back to, I think, 85. If you bought real estate pretty much anywhere on this graph, in fact, I loaded it up here somewhere. Where is it? I put the crash stats. Here we go. I'll show you that this is, okay, so this is real estate prices before the crash. All right, here's the crash. It was bad. It's really bad. Remember, that is a global economic depression that was caused by real estate, and that's what happened to real estate prices right there. But look what happened afterwards. And what's the distance, between here and your break even? It was 10 years. So if you have 10 years on your side, what this last crash proved to us is if you have 10 years on your side, you can win with real estate. You don't need, you can buy at the exact wrong time. I mean, at the exact wrong time, and you can still win. You don't need anything other than that, just time. And that's a worst case scenario. So, what we've learned here is that, and during this time, by the way, your tax bill's going down, you're paying less of a payment this whole time, right? As the assessment's going up, it's catching back up, but you're paying down. You have three things that are working for you when you own real estate. Three things that can potentially work for you. You have a tax advantage, right, which you get to take advantage of every year as you're paying interest. You have, the opportunity for appreciation. Homes can depreciate too, but you have the opportunity for appreciation, which only matters if you look to sell your home. If you keep your home forever, it won't matter what it's worth. And you also, when you're making your payment, you're paying interest, which you get to write off, but you're also paying principal, which goes towards a balance. So you have principal pay down as well. So those are three things that you get zero on when you rent, but you win with if you own. And this is why it's important to understand those particular three things when you look at this. But let's go back to this graph. So here, this is the .com recession right here. Real estate values went higher. This is one of the 90s where they went down just a little bit, but that was pretty much flat. This time they went down. But if you look at the last 5 recessions, 3 of those times real estate values went up during the recession. Why? Well, because when things become uncertain, people like the things that they understand. People gravitate towards the things that they know. People gravitate towards the things that make sense to them. And the great thing about real estate is that you don't have to be a genius to do well with it, and you don't have to be a genius to understand it. It's something that makes sense to all of us. We all are involved in real estate, unless you are homeless. If you're homeless, then you don't. But if you
so
are...
I got my second question.
Okay.
My second question is, you said KT has $5. I want to know what that little entrepreneur has done at a year and a half, 2 years old. What are these younger than that? These lemonade stands? Are these working out? He's got more money than Uber.
No, he actually, so I'm on the plan where I put $300 a month away for my kids from the time they're born. So he actually has like $4,000. But and it's the best thing you can do, because like for my daughter, in her case, I don't need to put any more money into it. I didn't want her to have too much money, and the market went up so much during the time that I was investing in it that it got to a point where I was like, okay, that's enough. Okay, you want to give them a head start. You want to give them a chance, I believe, to go and fail at something once. That's most likely what they're going to do with it. But let them get that out of the way early in their life. Like in my situation, I filed for bankruptcy when I was 30 years old, which sounds young now that I say it. But if I had the balls to do that when I was 21 or something like that, to go out and just fail, just go try and figure it out, then I would have had 9 more years of knowing better and knowing how things work, to build something for myself. So a big part of it for me isn't just education or whatever. It's an investment opportunity. Hey, do you want to invest in education? Do you want to invest in a property? Do you want to invest in a business? Do you want to try to live a dream? What do you want to do here? Do you want to backpack Europe? It's going to be your decision, but setting aside $300 a month is all you need to do to get them there. And it's something that's very easy to do if you can budget for it and set it and make it automatic, and then they can be in good shape. So so hopefully that answers your question, Steve. But when we look at this graph, the main thing you can notice is that we have the macro trend on our side, which is that we have a increasing population. It's drastically increasing, parabolically increasing, in fact. And we, on the counter side, we have a limited supply of real estate. And that's going to be, there's only so much of it. So that particular supply and demand equation means that you're going to see prices go higher over time. It's just going to happen. There's no way around it. Now, will there be fluctuations? Yeah, you can see these are fluctuations. But overall, what's happening? It's going higher. So, am I telling you to buy real estate because I think it's going to go higher? No, I'm telling you to buy real estate because it makes so much sense for so many reasons. Oh, and by the way, it tends to go higher. This is the graph. So the other thing, and I think this was noted pretty well in this article that we were referencing here, where Goldman Sachs is saying this downturn is going to be so bad, is that they're saying the recovery is going to be in the second half of the year. Well, that's not enough. That's not enough time for there to be a real estate crash. In order for there to be a crash in real estate, you really need a lot of time to build up. It takes a long time. I mean, if they start foreclosing on people today, or if people start missing their payments today, who are going to become foreclosed upon, we aren't going to see those foreclosures for 4, 5, 6 months minimum. I mean, maybe 8, 9 months. And so you need a prolonged, bad economic circumstance, a prolonged situation. You need at least a year to really be able to set up all the cards to knock down and cause a crash. Without a prolonged period of time, we're not going to get that far down the road. You don't have time for the fear to build up. You don't have time for people to hear the stories. Oh, Bobby and Sue had their home foreclosed on too. Oh my goodness, it's hitting everybody. You don't have enough time for that to happen like we did last time. And that was a big detrimental thing last time, is that a lot of people were hearing the whispers, oh, that property values went down over here. Oh, these people had a short sale. And then they started looking into their own situation, realizing they're upside down and going, honey, should we go ahead and get out of this now since they're allowing people to do it? And so people were short selling as a result of that. So I don't think we'll have enough time, Steve, to make that happen this time.
Yeah, I'm very interested to see. And in my opinion, these next 2 weeks, honestly, are critical. As we get into the beginning of May, I mean, I would say basically from today, we're at Tuesday the 14th. 3 weeks from today, when we're at, Tuesday, May 5th, I think we're going to have a very clear understanding of what this looks like. And is this bad? Is this recovery? Is this any of those types of things? Are we receiving new inventory? Is there new sellers that are putting their house on the market? Are we receiving new buyer inquiries of, hey, you know what, we thought about buying a home, and these are the types of things that now's the time that we want to jump in. I will say one thing, which is the owner-occupied side is where things are really good. I called a past client yesterday. She referred, husband and wife, they referred a client that actually closed yesterday, and so I wanted to say thank you for the referral. They said, so glad that we bought a house so that we can shelter in place in our home. The apartment that we were living in before was 800 square feet. We're now in 1,800 square feet, and it's ours, and we're both working from home, and it just creates some space and some love, and we're really happy that it happened.
Yeah,
so
that's cool.
That demographic, I think they're going to still be looking for opportunities in order to make a move.
Yeah, no, you're right. And I feel terrible for people who are in bad living situations during this. It's one thing that a lot of people don't talk about. I mean, I feel extremely blessed for everything that's been happening recently. And I'm going to share a few success stories. We'll talk about specific interest rate situations here too before we let you go, Steve. But there's people out there who are in bad living situations, and this is just like a nightmare for them. I really feel and pray for those people. So I wanted to give you a couple things here, Steve. Now, today, here's what's going on with mortgage rates. I showed you the graph, and I'll pull it up again here. But basically, we're seeing good interest rate opportunities. But why is it that interest rates aren't at record lows right now? Why? Well, here's basically what's going on. When bond prices go this high, we talked about how low yields are. The banks are in a situation where they can essentially determine what business they want. We just saw this yesterday with Chase. Chase said, hey, we're not doing mortgage loans for anyone who has less than 700 credit. Why would they say that? Are they being assholes? No. What they're doing is they're saying, you know what, we have so many loan applications to choose from. We know that the demand is so high for people to refinance and people to buy homes right now. We're just going to pick the cream of the crop. We don't want to mess around. I don't want to talk to people who have the lower credit scores. I just want to talk to the best loans out there. And that's what the banks like, the better loans, right? Because they're safer for them. They make more money on them. The people are more likely to pay. The more likely that people are to pay, then the better that they'll do in the long run with those loans through servicing and the other money that takes place after closing. So what you're seeing is, and even my bank is doing the same thing, they're just kind of turning on the spigot. They'll tell us like, hey, conventional rates tomorrow, we're going to drop them a bunch. So if you have conventional loans to lock them tomorrow. They're telling us that because they just want to turn on the spigot, go, all right, let's build up a bunch of conventional. So they're managing their pipeline very specifically, whereas in a normal market, they would not be able to do this. But because there's so much demand, they're able to just turn it on and just puppet master the whole thing and build the exact pipeline that they want. What's interesting today was we got the green light on VA, government, so VA, FHA. And I locked 3 loans today, conforming balance loans. So conforming balance in, let's see, did I put a blank one on here? No, I didn't. That was one of the ones we crashed. So conforming balance loans are loans that are under $510,400. You might be saying, well, there's no low limit for VA now. Well, there technically is at $2 million, but there's no loan limit according to the VA, but the secondary market has made it $2 million. However, rates change based on these different loan amounts. So over 510,400 is considered to be high balance VA loan. Under 510,400 today, Steve, I locked 3 loans at 2.75, and one of those people was getting a credit, meaning they got the 2.75 and they got $700 from me toward closing costs. So low or conforming balance VA rates are smoking right now. High balance VA rates, you start getting into the higher price points. I have a few people who are looking in that $600,000, $700,000, $800,000 range, and so forth. Those are a little bit higher. And what's going to happen is, as that market normalizes a little bit and they are able to assess the risk of those loans a little bit better, those rates will probably drop down as well. So we're going to see government rates are going to be really the place to be. Conforming is hard to say. The conforming rates have kind of been all over the place, but the VA rates, which is where I specialize, and also have, I do have one graphic I wanted to put up because we had made an announcement that we went to 640 credit. That quickly went away. We're back opened up to 600 credit. So we can do VA and FHA down to 600 credit scores. And that was something that we were really fighting for with our bank because we believe in serving the veterans out there. That's our main focus. And we want to make sure that if someone has a credit challenge, it doesn't keep them from owning a home if they can afford it and something that makes sense for their life plan and their home ownership strategy. So we're back down to 600 credit. But that just shows you that there is, right now, it's a very flexible market. There's so much business there that you really you have to have the right relationships, you have to do the right things, have to know when it's the right time to do stuff like pulling the trigger on locking those loans today. Those were not loans that I just got today. Those were loans I've been waiting for the right opportunity and the right time to take advantage of. So the market is good. There's lots of opportunity. But I'll tell you, Steve, it's not as easy to find it. It's not like in 2012 where it doesn't matter what you did. If you just bought a house, it's doubled in value since then. It's gotten where you need to be a little bit more smart about all the different steps that you're taking. Make sure that you have people who are looking out for you and helping you make smart decisions.
I agree. I love it. Let's go do it.
All right. Let's make it happen. I got one more stat for you, Steve. You ready for one more?
Yes, hit me.
All right. Equity. So we listed 6 or 7 things here today that are different between the crash and now. And this one is a big one. Back when we were, prior to the housing crash of 2008, a lot of people were buying homes with 0% down. They were getting 100% loans. The equity position was at one of the lowest points it's ever been at, even though prices had gone up a lot. And the reason was because there were so many new buyers who were buying with no money down. Now what we have, and this is released by Bloomberg from Atom Data, 53.8% of all homes in America have at least 50% equity. Okay? 37% of all homes are owned free and clear, Steve. 37%. 26.7% of the mortgaged homes have at least 50% equity. So we have a situation where there is just tremendously more equity. People have they're owning their homes for a longer period of time. These aren't a lot of people who just bought their homes. People have been buying homes since the downturn from the 2010, 2011, 2012. They've been hanging on to their homes. People have a lot of equity. The economy's been really good. People have put more money down when they bought homes. That is so important. I cannot tell you how crucial that is to the prevention of a real estate crash, because when we look back at last time, these people bought these homes with no money down and they had no tie to it. So they had no money into it. They had no skin in the game. How easy was it to walk away when things didn't look right? And especially when they got forgiveness from the government, it's like, oh, well, gosh, who cares then? I don't have anything in this. This isn't, I didn't put any money down on this. When you have put down a significant amount of money that you've worked hard for, when you've put down $30,000, $40,000, $50,000 into a home, a lot more different conversation on the pillow talk, if you will, of should we leave this place behind or not. And no one's even gotten to that point yet. And I don't even think we'll even get to that point for most people. They won't even have that conversation. Whereas last time, that conversation was being had a lot, and the decision was very easy for a lot of people to say, let's leave the place behind. Those conversations won't be having this time, Steve.
Yeah, I completely agree. And I think that's one of the other things that's really going to help our market is sellers that have all the makings of being reasonable, because instead of making $150,000, I'll make $135,000 in order to put this deal together and make it good for everyone. I think it's great. I honestly do. Certainly want to encourage everybody to be safe, whether it's looking at houses. The protocol is getting real in terms of face masks and one at a time and watching what we touch, and certainly want to encourage everyone to be safe. And business is still happening. There still are opportunities, and there's, who was it that said, was it Warren Buffett, be greedy when people are fearful and fearful when people are being greedy? Right now there's a lot of fear in our market and looking for not necessarily being greedy, but looking for opportunity, I believe that there is some.
Yeah, I think he could have chose better words there. Maybe be opportunistic when others are fearful instead of be greedy. Kind of sounds like a shitty thing to say. But Steve, thank you so much for your time, man. I know this has gone over a little bit for us. Really appreciate you taking the time to chat with me today. Thanks, brother.
I love you. Talk to you soon.
All right, talk to you soon, bro. That's Steve Ploetz, and I just wanted to, make everyone aware of kind of, what these different elements are, because there's still a lot of fear mongering going on, particularly in the media. We saw the article from Goldman Sachs, and I wanted to point that out because a lot of people actually sent this to me, and they got lost. When people just read the headlines, if you just read this part, then it looks really bad. But you got to remember what they're predicting is an unprecedented recovery on the other side. So for certain, there is absolutely no reason to panic sell your real estate at this point. Absolutely no reason to do that. If you're a seller and you have the ability to wait, then you should. If it's up to you and you get the choice, you don't have life happening to you, 100% you should wait. Buyers, though, for those people who can't wait, this is your opportunity. This is what we've been waiting for. You've been waiting for a chance for the market to balance out. You've been waiting for a chance to have the ability to negotiate with sellers. You finally have that now. And I would highly recommend looking at taking advantage of it. You're looking to buy a home, or if you want to look into refinancing your home, particularly if you have a VA loan, which is my specialty, give me a call. My number's on the screen. That's my NMLS if you want to look me up. I appreciate your time. Hopefully this is helpful for you.